Well, the margin is like good faith money. And it turns out that the margin is different in terms of the percentage of the underlying contract depending upon the underlying contract. So something that is not that volatile, such as a treasury bill, has a fairly low margin deposit because the price doesn't fluctuate that much. Whereas something like the S&P 500 has a rather large margin that's required. So the margin is set to reflect the volatility of the underlying commodity that we're looking at. Low volatility commodity implies a low margin. High volatility commodity implies a high margin. And roughly speaking, the margin is usually set at about 4 times the volatility. So margin is the mechanism whereby you can set the risk of your position. So if somebody says that, well, I don't want to invest in futures markets because they're too risky, it's clear that this person doesn't really understand the fundamentals of futures trading. You determine what the volatility is. You determine how much margin money to actually put down. The risk is in your hands.